Hello everyone, this is Jennifer. So in this video we're going to do problems on cash flow statement. So first problem, calculate the cash from financing activities. So they are telling us to calculate only the cash which we have gained from the financing activities. So whether we have to see whether all the items are part of the financing activities. So what do you basically mean by the word financing activities? So in financing activities, basically it predicts claims of future cash flows by providing the funds of both the capital and the borrowings to the enterprises and how the funds are being utilized. So basically examples of cash flows arising from financing activities would be cash proceeds from issuing shares or cash proceeds from using debentures or raising loans, notes, bonds and other long-term borrowings and other short-term borrowings, and cash repayments of the amount borrowed. When you repay the amount, that also comes under the financing activities. In short, financing activities are activities basically that results in changing in the size and composition of the owner's capital and borrowings of the enterprises. So let's look on to the question right now. So issue of equity shares. So issue of equity shares is part of the financing activities as it deals with composition of the capital. But issue of equity shares, what happens is it is a inflow of funds. The funds come into the business, hence you're supposed to add it. When there is inflow of funds or inflow of cash, you will add it. When there is outflow of cash, you will minus it. Issue of debentures, again inflow and its financing activities, you will add it. Redemption of preference shares, so you're redeeming back your preference shares, so at that time there is outflow of cash, hence you will minus it. Raising of long-term loans, so basically you're raising long-term loans, at that time cash is coming into the business and it is a part of the financing activities, hence you will add it. Repayment of bank loan, you're repaying something, at that time cash is moving out and bank overdraft is also part of the financing activities, hence you will minus it. Dividends paid, so when dividends are paid, it is also comes under financing activity, because equity shares, when you raise equity shares, obviously you're supposed to pay the dividends which you're supposed to pay to the shareholders, which is a part of the profits of the organization. So that also is a part of financing activities, and dividends are paid by the company, hence there is outflow of cash, hence it needs to be reduced or deducted or minused separately. Interest received, so you're receiving some sort of interest, so either it can be when you have invested in something and you're receiving interest for something, which also is a part of financing activities. So the next one is sale of furniture. Sale of furniture, if you see, the purchase or sale of fixed assets are part of investment activities because it includes the purchase or sale of long-term assets, so it does not come under financing activities, hence we will ignore the sale of furniture. So we'll start up with the solution. So cash from financing activities, under that the first one is issue of equity shares. So issue of equity shares is 5 lakhs. So it is a inflow. Issue of debentures, issue of debentures also is an inflow, which comes under here. Then redemption of preference shares. So redemption of preference shares is basically outflow of funds, so we will minus it. Then raising of long-term loans. Raising of long-term loans, you're raising some sort of long-term goal, hence it comes under inflow of funds, so you will add it. Next is repayment of bank overdraft, you will minus it because outflow of funds. Then dividends paid, again it's outflow of funds. Then interest received, inflow of funds, you will add it. So now what is the total that we get? We get 13 lakhs as the total. So if you minus 13 lakhs with 2,50,000, 2 lakhs and 1 lakh, so all these will be minus because this includes the outflow of cash. So when you minus 2,50,000, 2 lakhs and 1 lakhs, you get the resultant figure to be 7,50,000. So this 7,50,000 is nothing but net cash from financing activity. So now let us move on to the next question. Our next question: from the following balances, calculate the cash from operations. So how are we supposed to calculate cash from operations? So we have a format here which is given. I'm just showing you all the format how to calculate the cash from operation. So first you're supposed to have your net profit before tax. Sometimes what happens, net profit before tax will not be given. They would have given net profit of the current year after appropriation. So at that time we are supposed to find out the net profit before tax. So at that time you're supposed to add whatever you have debited in your profit and loss appropriation account, like your transfers, proposed dividend, interim dividend paid during the year, etc. Then you will get your net profit. Then you will add your provisions for tax made during the current year. Then you will minus the refund of tax that has happened during the current year. So the resultant figure will be nothing but your net profit before tax. So only if they give net profit before tax, we will go ahead. If they give only net profit of the current year, then we're supposed to do this calculation. We're supposed to find out net profit before tax, and only then we can find out the cash from operational activities. So after net profit before tax, you're supposed to add all the non-cash and non-operating expenses. Then you will minus your non-cash and non-operating incomes. Then you'll get something called as operating profit before working capital changes. Then you will add your decrease in current asset and increase in current liability, less increase in current asset and decrease in current liabilities. Then you will get the resultant figure as cash generated from operation. Only after this you will minus your income tax paid and you will get your net cash from operating activities. So in this they have given the items. So let's distinguish the item respectively. So they have given it as bills receivable 50,000 and 47,000. So bills receivable will come under, bills receivable is a current asset. So when it is decreasing, you will add. So decrease in current asset and increase in current liability will be added. I again repeat, in order to find out decrease in current liability and decrease in current asset and increase in current liability will be added. So bills receivable is reduced, so you will add it. Debtors is increased, it's a current asset, so you will minus it. Bills payable is increased, which is a current liability, so you will add it. Creditors is decreased, which is a current liability. A current liability decreases means you will minus it. Outstanding expenses, the expenses which are outstanding is a current liability. If you see, it has increased, so you will add it. Prepaid expenses, last year it is 800, current year it is 700, it has decreased. Prepaid expenses are it's a current asset, so it has decreased, so you will add it. Accrued income, so 600 and 750, it has increased. Accrued income is a current asset, so the income which is not received but yet to be received, so you will add minus it. Income received in advance is an expense. It's a current liability, so you will minus it. Since it's an increased income, profit made during the year is nothing but your net profit. So we will start out with our cash from operation. You will start with net profit before tax. Net profit before tax. Under that you will have adjustments. I go according to the format. Adjustments for non-cash and non-operating expenses. We don't have any adjustments given for us, so we don't have anything to do with. Now at the non-cash or non-operating expenses, there also we don't have anything. Then you will minus the non-cash or non-operating incomes. Then after doing all this, you'll get something called as operating profit before working capital changes. So now what you will do, now you will add the decrease in current asset and increase in current liability. So if you see what all current asset have decreased, so bills receivable have decreased. So bills receivable, what is your decrease amount? Decrease in bills receivable. So the amount is 50,000 minus 47,000, you get 3,000. Next, debtors have increased, so you will minus it. So let me write down the format first. Minus increase is just a reverse of it. What we add, we will minus the reverse of it. Increase in current asset and decrease in current liability will be minused. So your debtors has been increased, so you will add it because it's a current asset. So increase in debtors, so the amount is 10,000 minus 12,500, 2,500. Now your third bills payable 20,000, 25,000. Bills payable is a liability. Bills payable has increased, so you will add it. Increase in bills payable. So to 20,000 minus 25,000, you get 5,000 as your answer. Then creditors, last year it is 8,000, this year it is 6,000. Creditors is a liability, it has decreased, so you will minus it. So decrease in creditors, so it is 2,000. Outstanding expenses is a current liabilities. Expenses are yet to be paid. So last year it is 1,000, the current year it is 1,200. It has increased, so you will add it. Increase in outstanding expenses, 200. Prepaid expenses as decreased. The prepaid expenses is a current asset. So decrease in prepaid expenses is a current asset. It has decreased, so you will add it. So decrease in accrued income, last year 600, the current year it is 750. So accrued income is basically a current asset. The income is which is yet to receive. It has increased, so you will minus it. Increase the last income received in advance. Income received in advance is a current liability, so it has decreased, so you will minus it. Decrease in income received in advance, so the amount is 550. So net profit before tax is 70,000. So now if we add all this, we get the amount to be 8,300, so which is equal to 70,000 plus 8,300, you get 78,300. Now let's minus all this. So the answer is 73,100. This is nothing but cash from operating activity. Now let us move on to the next question. Our next question is The following details are available from a company. So I've given the liability side, asset side, you have the previous year and the current year given. So first we are supposed to prepare the entire, it's a full statement of this that you're supposed to prepare. So it will include cash from operating activities, cash from investing activities, and cash from financing activities. So we will start with the discussion of the question. So share capital, if you see, share capital comes under financing activities. So share capital has increased. So if it's increased, which means you have issued shares. If it is issue of shares, you will add it because there is inflow of cash. Debentures, last year it is 12,000, the current year it is 6,000. It is reduced, which means debentures have been redeemed. So which means to tell there is outflow of cash, so you will minus in your financing activity. The third one is reserve for doubtful debts. So reserve for doubtful debts is a current liability. So if it is an increase in current liability, you will add it in your after your operating profit before working capital changes. Then trade creditors, again it's a current liability, it has increased, so you will add it. Profit and loss account, it is the opening and closing balance, so net profit is not given, so this you will take it in your, this is what is the amount you will start with your cash flow statement. So cash opening and closing balance will be taken respectively at the end of the statement. Debtors is a current asset, it has increased, so which means to tell you will minus it. Stock is a current asset, it has decreased, so you will add it. Land is a fixed asset, it comes under investing activity. So land, last year it is 20,000, the current year it is 30,000, it has increased, so which means land has been purchased. If some purchases happen, basically there is outflow of cash, so you will minus it. Goodwill written off will be taken as non-cash item, so you will add your non-cash items. So our first additional information is dividend paid, total of rupees 3,500. So dividend paid will come under the appropriation. Since we have the net profit, so we're supposed to calculate the net profit before tax, so you will add your dividend paid so that it will be, you will be able to calculate your net profit before tax. So your proposed dividend for the current year, interim dividend, so if they give only net profit, you're supposed to calculate a net profit before tax. So here in this question they have given net profit, so you're supposed to add your dividend and then you'll get your net profit before tax. Then land purchase, as I told you earlier, it will be minused in your investing activity. Amount paid for amortization of goodwill, rupees 5,000, it is nothing but goodwill written off. Debentures paid, 6,000 is nothing but the redemption of debentures, so it will be minus. So we'll start with the cash flow statement. So you start with cash from operating activities. Under that you have been given the net profit. So what is your net profit being given? So it is 10,040 minus 10,560. So you get your profit before tax to be 520. Then you're supposed to add your dividend paid. So any dividend paid or reserves transferred to reserves will be added if they give net profit alone. If they give net profit before tax, then you will not add it. So dividend paid is 3,500. So you get your resultant figure to be 4,020. This is nothing but net profit before tax. So now what we will do is we will add the adjustments for non-cash and non-operating items. Adjustments for non-cash under that we will add all our non-cash and non-operating expenses. So we will add the non-cash or non-operating expenses. So under that, the only non-cash expense that we have is the goodwill written off. So goodwill is written off to the extent of 5,000. So goodwill written off Now nothing else is given in the question regarding any other non-cash or non-operating expenses. Let's move on to the next heading, which is non-cash and non-operating incomes. So under that we have nothing, so just add it. So we will get the resultant figure to be 9,020. So this 9,020 is nothing but operating profit before working capital changes. So this operating profit before working capital changes is 9,020. Now what we will do, we will add the decrease in current asset and increase in current liability. And we will minus the increase in current live asset and decrease in current liabilities. So what all asset we have? First let's look from the liability side. So reserve for doubtful debts has increased, so you will add it. So increase in reserve for doubtful debts. The increase amount is 100 rupees. 700 minus 800, 100. Trade creditors also has increased, so you will add it. Increase in the current liability. Increase in trade creditors. So 11,840 minus 10,360, you will get the answer to be 1,480. Next, moving on to the asset side, we have the debtors and stock. Debtors have increased, so you will minus it. So increase in current asset will be minus, so increase in debtors, the amount is 17,700 minus 14,900. So the amount you will get it to be 2,800. And next current asset that we have is stock. So stock has decreased, so you will add it. So decrease in stock, it is 49,200 minus 42,700, which you will get the amount to be 6,500. So now let us add and see how much are we getting it. So if you add it, you will get the amount to be 8. It's 9,020 plus 8,800, you get 17,820. So you get the amount to be 8,080 and 17,100. So now we will minus this. So 7,100 minus 17,100 minus 2,800, you get 14,300 as your answer. So this is nothing but the net cash from operating activity. Now let's move on to the calculation of net cash from investing activities. Cash flow from investing activity. So now what are the cash flows that we have with regard to investing activities? So only the long term assets, the purchase and sales, that is what will mainly come under investment activities. So if you see, the land has been purchased for rupees 10,000. Even if they don't give in the adjustment, also by looking at this itself we get to know that if it's an increase, it's a purchase. So if it's a purchase, you will minus it. So minus land purchased. So you get the amount to be 10,000. So which is a negative figure because it is in minus. So now if you minus 10,000 is nothing but this 10,000 is the cash flow from investing activities because we don't have anything else to be done. So this is the net cash flow from So now let's move on to the third part, which is cash flow from So this cash flow from financial activity basically includes the composition or the increase or decrease in the share capital of the company. So basically, if you see our share capital has increased, so it is issue of shares, debentures have decreased, so redemption of debentures. I think only two of the things we have, and the dividend paid. We will make a note of it. So issue of share capital, the amount is 4,000. So you have the share capital to be 70 and 74,000, so increases 4,000. So next we have debentures, which has decreased by, which has been redeemed by 6,000, and dividend, which is paid by 3,500. When it is outflow, you will minus it. So minus debentures redeemed so it is, the amount is 6,000, and you'll again minus the dividend paid because it is again outflow of cash. Now let us total it up and see how much are we getting for the net cash flow from financing activities. So it is 5,500, which is nothing but the net cash flow from financing activities. Now we will total up the net increase or decrease in cash. So the net increase or decrease in cash is nothing but A plus B plus C, which is the total of cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So operating activities 14,300 minus 10,000 minus 5,500. So your resultant figure is minus 1,200. So now what we will do, we will add the opening balance of cash. So if you see the opening balance of cash in your question, they have given us 9,000 and closing balance is 7,800. So the opening balance of cash is 9,000. So now we have to get the cash equivalent to closing balance of cash. So if you see, we are getting the resultant figure to be 7,800, which is nothing but which is absolutely equal to your closing balance. So if you add your net increase or decrease with the opening balance of cash, the resultant figure should always be equal to the closing balance of cash. Only then the statement is correct. Thank you everyone. Thank you everyone.